Continue our conversation about the consumer and credit with the CFO of Enova International. Joining us, Steve Cunningham, CFO at the financial services business with a focus on small businesses, underserved consumers. Steve, thanks for being here on the Schwab Network.
Hi, Oliver. It's great to see you again. Thanks for having me.
Appreciate that. Tell us firstly where you guys kind of see that conversation we just had about the consumer, their indebtedness level, their ability to pay it off with strong employment. Do you guys see a steady kind of pipeline of consumer strength?
Yeah, as you know, our customer base and the consumer side is largely non-prime. And in some cases, those customers are always sort of living in recession or near recession, but they're very good at managing their day-to-day cash flows and how they manage their finances. But we've seen good strength in terms of the demand that we're seeing. We've seen growth in real wages as inflation has come down, and the employment situation in particular for these customers is really strong. So we closed out Q4 with some strong growth, good earnings, and we feel pretty bullish if we can keep this momentum going into 2024.
What will determine the if there? Is it macro? Is it competition? You guys certainly are not alone in trying to use kind of new machine learning tools to wade into the subprime area without getting risk attached to it.
Yeah, well, we laid out our expectations for 2024. We feel like we can grow our originations at around 15% from where we were in 2023. And we were just under $5 billion of originations in 2023. Obviously, we would need the macro backdrop to stay at least constructive like it is now, and no material changes in that employment situation that we see. And if we were able to do that, we think we can grow pretty meaningfully in 2024.
Okay. Looking at the earnings from the last week, market gave you guys a little bit of selling pressure, but it looks like your earnings continued to climb from a year ago. Your revenues were up 20%. Where is that mostly coming from right now?
Yeah, so pretty equally across the board. We had our 9th consecutive quarter of $1 billion or more of originations. Originations were up in Q4 over 20%, which drove that revenue growth that you spoke about. We've seen it in both consumer and in small business. Record level of quarterly originations for our small business lending franchise. So you talk about competition. We've seen relatively benign competition. We have an incredibly strong balance sheet, really strong brand recognition in our customer spaces, and that's allowed us to continue to drive the earnings growth that you mentioned there.
The adjusted EBITDA up 8.6%. Year over year. As I mentioned, the revenue's climbing 20% to $583 million, a pretty big jump from when we spoke June last year, which was around a little shy of $500 million. So you guys have continued to bring in the revenue. The buybacks too, so it seems like you guys are pretty comfortable with the cash flow and your financial structure right now. What comes next with that?
Yeah, so we've if you look at our investor materials, you can see over the last 7 years, we've been able to return to our shareholders. Our share price has been up around 30% per year, every year. But we still trade, if you were a member of the S&P 600, and if you just look at where we sit today on a forward multiple against that index and the consumer financial pieces of that index, or even the Russell 2000 financials, we still feel like we're undervalued. So we took some steps to enlarge our buyback program, and going into 2024, we had a substantial amount of our market cap available for a buyback. And I think at these levels, we feel we will be a buyer because we do feel like, given our historical performance and the outlook that we just talked about last week, that we still have some value to go, even though we've done really, really well over the past 6 or 7 years.
Okay. There is a moment right now where a lot of people are trying to figure out when the consumer will become overburdened. The idea that they can take on debt, pay it back when they've got pay it down because of their job, because of their strong employment outlook. Is that kind of your main sort of a barometer for what you see in the future? Is it watching employment? Will you be sensitive if there are breaks and people go, you know what, I didn't make the payment this month?
Yeah, well, to get a consumer loan with Enova, you need a job or a verified source of income, and you need a checking account since we are online only and only work through the ACH network. So we will be watching employment closely. And as I mentioned, it's been pretty robust. A lot of our customers play in spots where you're able to not only have one job, you can have multiple jobs if you so desire. They tend to be in the more of the hourly, non-white collar type job spaces, which have seen a lot of stability and strength. So we'll keep an eye on that. And I think the other piece of it is our portfolio turns over very quickly. So our payment frequencies tend to be every other week or faster versus monthly. And so we can keep an eye on defaults, whether they're in line or we're surprised by them one way or the other. And we can calibrate very quickly to either reduce risk or take on more opportunities, just given how quickly our book turns over and how quickly customers repay us.
I'm curious your thoughts on the regulatory standpoint. There was some chatter that maybe the CFPB would be applying more stringent regulations to so-called payday lending practices, that they might bring back a rule from 2017 that would require lenders to confirm, quote, ability to repay. It was something that was knocked down by the Trump administration. Thoughts on that?
Yeah, so that's been in the works for many, many years. In fact, just to be clear, Enova is no longer involved in payday lending at all. Any pieces of that rule, if it was to be adopted, we're ready for it and would have very little impact on us, just given the changes in our business since they originally started talking about it. But I think there's still some skepticism as to whether the courts are going to allow that to continue to go in. And just to be clear, we are supervised by the CFPB at the federal level.
Yeah.
And we have been for many years. So we think our space in terms of the non-prime lending, they've actually encouraged a lot more parties to get involved in that space versus not. And I think the CFPB is focused on a few other things other than the subprime, non-prime consumer and small business markets right now.
Okay. Hey, Steve, last thing. Are you guys taking any of the breakthrough AI tech into your models? Is there any utility of it there at all?
So, we've been very careful to separate the difference between machine learning and artificial intelligence. So we've been a machine learning shop for a very long time, which at the end of the day just helps our humans work more effectively and faster, more productive. AI, I think you have to pick your spots. There are pieces of generative AI that will work within our operations to make us more efficient, whether it might be in coding or in our broader customer service operations, but not so much in underwriting, given the complexities and the touches to consumer compliance.
All right. Thank you very much for your time as always, Steve. Good to have you back.
Great to see you. Thanks.
Sure. Thanks, Steve Cunningham, CFO at Enova International, up about 10% over the last 52 weeks.